Welcome to the deep dive. We're here to really dig into complex stuff and pull out what matters most for you. Today, we're looking at something, well, fascinating, how investment growth can actually become the fuel to launch and, really scale a business. Think of it maybe as a different kind of path to understanding business funding. So for this, we've reviewed a briefing document and some key parts from a text called Business, Investment, and Startup Capital Strategies. Our goal really is just to pull out the most useful bits of insight about funding new ventures from these materials, help you see how it works.
Exactly. And the core idea we're exploring, it's a strategy focused on creating significant startup and working capital. But not through the usual routes like loans or VC money. It's directly from specific investment methods. And it's really important to say this up front, just like the source material does. This is all for educational purposes. We're just helping you understand a concept. It's definitely not financial advice. And, investing always has risks. So the results they talk about, well, they may or may not happen. That's a direct quote they use.
Okay, right. Let's unpack this then. To really get it, we need some basic terms the source uses. First one, investment startup. Now, this isn't like your typical company startup. The source defines it as the initial money you put into an investment venture itself. And the only goal is generating cash for a future business. Basically, using money to make the money you need for your business.
That's it. And the engine behind it all, the thing they call the compounding mechanism, that's where the real power is supposed to lie. It's that process, where investment earnings aren't just taken out. They get put back in, reinvested, so they generate more earnings. It leads to that exponential kind of growth. And what's really key here from the source is that this compounding happens weekly.
Weekly, wow.
Yeah, that frequency is what they say really accelerates the whole thing, much faster than, say, monthly or yearly.
Okay, so those profits start coming in. And the source is very specific about how to use that money, right? It carves it up. You've got startup capital. That's money taken directly from those investment profits specifically to launch a business.
So it's not outside money, it's generated internally.
Exactly. And then critically, after you've used that startup money, what's left is called sustainable capital. This is the bottom money that remains. And according to the source, it continues to generate income. Think of it like the ongoing financial engine. Keeps things running after launch.
Right, like a buffer that also grows.
Yeah, provides that continuous stream.
And then part of that sustainable capital is specifically tagged as working capital, defined as the bit that's readily available for day-to-day business operations and expenses. I mean, imagine the flexibility there, not just scraping by, but actually having funds for operations without constant worry. That's a big deal for any business owner listening. Definitely. The source also mentions threshold goals. These are like specific targets within the investment journey, like, say, growing an initial $1,000 investment until the profits get you to a $10,000 level, and so on. Yeah. Milestones.
Wait, and just to be clear, the people behind the source material, they call themselves financial educators, right? Their role is teaching concepts.
That's right. And they really make a point throughout the material to stress the risks. They keep saying investing is risky, and these numbers are projections, so results may or may not happen. They're very careful about that.
Got it. So now the part that really caught my eye, the numbers. The source lays out 3 main strategies, all over 3 years, and all based on that, well, pretty striking 3.5% weekly compounded profit figure.
Yeah, that 3.5% weekly is high, and it's the engine driving these specific projections. Let's look at them. First, the $1,000 investment strategy. Start with $1,000. Year one profit is projected around $5,000. They position this as sort of getting you to the next level. But over the full 3 years, the potential profit they project is roughly $214,000.
From 1,000.
That's the projection of that weekly compounding. From that, they suggest allocating $50,000 as startup capital for a business, which leaves about $164,000 as remaining sustainable capital.
Still a very healthy amount.
Right. And then, get this. The available working capital from that sustainable pool just after 1 month of the business running is projected around $26,000.
Wow. That's quite a jump from just $1,000 initially. And the source emphasizes that $1,000 is achievable for everyone to save up, making it seem like a really accessible starting point.
Exactly. It's framed as the entry point. Now, moving up, the $5,000 investment strategy starts with $5,000. Year one profit projection, almost $30,000.
Okay.
Over the full 3 years, this one is projected to cross the $1 million mark, roughly $1,020,000.
Bigger from 5,000.
Again, based on that consistent 3.5% weekly compounding over 3 years. From this, they still allocate $50,000 for startup, leaving a very substantial sustainable capital of around $970,000.
Yeah.
And the working capital available after just 1 month, about $164,000.
That's significant operational cash.
Very. And finally, the $10,000 investment strategy, for those starting with a bit more. Initial $10,000. Year 1 profit, nearly $60,000. The 3-year profit projection, it climbs to about $2,141,000.
Over $2 million.
Yeah. And here, the suggested startup capital allocation doubles to $100,000, leaving just over $2,041,000 in remaining sustainable capital, and the working capital after 1 month, projected around $328,000.
Those figures are, well, they're definitely attention-grabbing. They really show the potential scale according to this model.
Absolutely. And what's fascinating, as the source points out, is it's not just about the numbers themselves, it's about the principles behind achieving them. There's a strong emphasis on commitment to the process and long-term vision, sticking with it for the full 3 years.
Right, not dipping in early.
Exactly. That dedication is framed as crucial. And of course, the power of compounding, especially that weekly compounding, is highlighted as the absolute core driver.
So how does this translate for someone thinking about their business? It seems to really highlight strategic capital allocation. It's not just having money. It's about using it smartly, dividing it up like that startup sustainable working capital. It creates a kind of self-funding system.
Precisely. A financial ecosystem almost. And the ultimate goal, as the source presents it, is financial freedom. The idea is that this kind of setup allows business owners to, and I quote, focus on growth rather than immediate sales or financial stress.
Imagine running a business without constantly worrying about next month's bills. That's a powerful idea.
It really is. And again, just to keep it grounded, they always circle back to the risk acknowledgement. Investing is risky. Outcomes may or may not happen. It's a constant refrain.
So the implications for a business seem huge if you have that working capital buffer. You can genuinely shift focus from sales pressure to brand building and scaling, make longer-term strategic plays.
Right. And it also provides resilience in economic shifts. Having that cushion during tough times like a recession or something unexpected like a pandemic, it helps businesses survive.
Yeah, it could literally be the difference between staying open and closing down. The source mentions avoiding business closures as a key benefit.
Exactly. And achieving that freedom from financial stress, operating without that constant worry about monthly income. The aim is substantial business funding generated internally, like that example, a $5,000 initial investment, potentially funding a substantial business startup.
And there's another layer too, isn't there? Something about community.
Yes, the source talks about community and referrals. The idea seems to be about sharing the strategy, helping others. They mentioned a 4x4 referral model, aiming to build a network or a club or campaign.
So it's not just individual gain.
Apparently not entirely. The source states a larger goal, to help over 1,000 families per month improve their finances through this strategy. Sort of a collective effort to get finances in order. It adds an interesting community dimension.
Okay, so wrapping this up, what's the main takeaway for you, our listener?
Well, this deep dive showed how a specific structured investment approach, especially one using aggressive weekly compounding according to the source, could potentially generate serious capital. Enough to maybe launch or significantly grow a business, all funded internally. It's about creating your own financial power source.
Yeah, we've explored how the source suggests strategic investing could lead towards not just business stability, but real financial freedom. It kind of flips the script on traditional funding. It presents this idea that your investments could actively, build your business dreams brick by brick. So thinking about all this, the commitment, the long-term view, that strategic way of using capital, how might applying even just the principles behind these insights allow you to perhaps reimagine how you fund and grow a business, or maybe tackle a major personal financial goal? Something to think about.